Welcome back to part 2, second video in chapter 3, and I finished the last video by asking the question, why do we even make adjustments? Why do we make adjustments? This can be tricky stuff. But the first reason we make adjustments is that as we report information, remember accounting is an information system. As we report information, we report it on a periodic basis. A periodic basis for reporting information. What do I mean by that? We're going to report monthly, or we can report quarterly, or we can report semi-annually, or we can report annually. Certainly we're going to be reporting annually. But we also report monthly, and those may be financial statements that are viewed only internally by management, but we're still going to break our accounting, our information system is going to be broken out into time periods. And so we're going to have time period 1, which is here. And then we're going to have time period 2, which is there. And then we're going to have time period 3, which is here. And then we're going to have time period 4, which is there, etc. But because you see these time periods that we have, 1, 2, 3, 4, the first reason we make adjustments is because we have a periodic basis for our reporting of our information. So that plus, let's put a plus the fact that we're reporting our financial statements according to generally accepted accounting principles. And what we're going to see is there's two primary ways for reporting financial information. The first is cash, and the second is accrual. This one right here, it's this accrual guy. It's because of accrual accounting, which is GAAP, generally accepted accounting principles, is accrual accounting. Cash is not GAAP. You cannot report according to cash. Cash means that we record, I don't know if you remember this, cash says that we record revenue when we receive it, and we record expenses when we pay them. Cash says that we record revenue when we receive it, and we record expenses when we pay them. So just using this visual right here, if you worked for an entire month and I didn't pay you, if this is the month of January, let's say you worked the entire month of January and I didn't pay you until February 2nd, cash basis would say we record that expense in February. Accrual basis would say this: if you work the entire month of January and I pay you in February, we need to record those expenses in January. See the difference? Accrual says that we record revenue when it's earned, and we record expenses when they are not paid but incurred. We underline these with different colors. Here's received, here's earned. Here's expenses when we pay them, expenses when we incur them. Again, back to our illustration. We're thinking of payroll right now. Cash accounting would say this: you work the entire month of January. I pay you February 2nd. It gets recorded in February when we pay it. It shows up there as an expense. That is not generally accepted accounting principles. Generally accepted accounting principles is accrual accounting, which would interpret that same set of situations, that same set of circumstances this way. You work the entire month of January. It gets paid in February. The expense is recorded when it is incurred, not when it's paid. So when is it incurred? The answer is in January. That's when the expenses were incurred. It works the same way for revenue. That revenues are recorded when they're earned, as opposed to revenues are earned when they are received. So we're selling sneakers, and over here in the month of January, we sell you $100 worth of sneakers. And you say, I'm going to pay you in February. Cash accounting would say this: that $100 that we earned in revenue is recorded when it is received in February, because that's when the $100 was paid. Generally accepted accounting principles, or accrual accounting, would say this: that the revenue is recorded when it's earned. When was it earned? It was earned in January when we shipped the goods. We shipped the goods in January. They got paid for in February. So this is why we need to make adjustments. That's all I'm going to talk about in this video. It's the fact that we have a periodic basis for reporting, and we're using accrual accounting because that is generally accepted accounting principles. Those two things married together result in adjustments. The necessity for making adjustments. In the next video, we'll begin to look at what are the adjustments that we have to make. See you in the next video.